thank you for coming. I'm sure it's going to be very, very informative. And if there's any questions, Eunice has been very kind and she will do her best to answer them. So yes, it's Eunice that will be giving the presentation on tax info. And so at this time, I'll hand it over to Bridget.
Thank you, Susan. Hi, everyone.
Thank you.
So I will be introducing our speaker today, Eunice Tan. She's a manager at Yale PGC LLP at its Young and Eglinton office. Her experience includes compilations or financial statement preparation, reviews and audits, corporate and personal taxes, and tax planning and research. She works with clients in different industries. Among them are private practices such as medical, legal, and dentistry, entertainment, real estate, manufacturing, and retail, nonprofits, and charities. She's also a mentor for students in the CPA program and is currently taking the in-depth tax program with CPA Canada. During her free time, she likes to try new food spots or restaurants, attend aerial hoop classes, and do some art like watercolor, oil pastel, or happy mail. On Saturday mornings, you will usually find her volunteering at the cat shelter. Welcome, Eunice.
Thanks so much, Susan and Bridget, for the introduction, and Alan as well for the opportunity. I will start to share the PowerPoint presentation. Yeah, so does everyone see the slides, I guess? Good. So for today, we will do some personal taxes, although the personal tax season was done and it was finished like back in April 30th, but hopefully this can help get you some more information or more knowledge. So when you guys prepare your personal taxes for the upcoming for 2023 next year, then you'll be more informed of the different benefits that is available to you guys and in your situations. So just a recap. So taxes here in Canada, they're usually payment, and the payment is always due like April 30th, but the timing or the time when you can file your tax returns, it depends on your situation. So normally it's also due April 30th, but if it so happened that you or maybe your spouse or common law partner is self-employed, maybe they have their own business or their own practice, they have like a sole proprietorship, then the deadline of their filing is actually June 15th. So maybe this can apply to some of you. And just take note that if the deadline falls on a weekend or if it's a holiday, then the deadline becomes like the next business day. Like what happened back in April 30th, I think it was a Sunday, so the deadline was actually May 1st. So here we'll just look into a few taxable benefits that's available to you. And these are benefits that you can apply to with the government. So the most common ones, oh, before I forget, so taxable benefits are treated as income. So the most common ones are the old age security or OAS. We have the CPP or the Canada Pension Plan. And one among that is the CPP disability pension. But by taxable benefits are treated as income, we mean like if you receive this, for example, in this year, in 2023, you have to include that you will receive a tax slip from the government and you have to include that on your tax return. So you get taxed on it. So first is the old age security. So this is a type of a retirement pension. So amongst OAS, there's CPP, there's also a guaranteed income supplement. So this is one of them. And just take note that you will be able to receive this pension monthly. like most pensions from the government. And this one usually applies when you are age 65 or older. And you have to apply this through Service Canada. Just take note, it's not through CRA. So it's through Service Canada. And in most cases, it's once you reach the age like 65, like you will be automatically enrolled into this. You would just receive a letter from Service Canada notifying you that you're enrolled and how much you'll be getting each month and when you'll be start getting them. So usually if your information with Service Canada is updated, like something about like your driver's license or maybe your OHIP, they usually enroll you once you reach 65 years old. So, but in certain cases that you may have to apply manually. And the first payment is, you'll be receiving the first payment 1 month after you've turned 65. So let's say you turn 65 sometime in May, you'll be getting your first payment in June. You should have received a letter already by that time. So once you get your payment, should be sometime in June. I left some information here just in case you guys want to look at the link. I'll give you, I believe Alan and Susan or Bridget will be providing you guys a copy of the presentation. So these links can be accessible. And if you ever need to apply manually, I also left a link. So you can apply online. You may just need a Service Canada account to do that. Or if not, like you can also apply by paper and mailing that paper form. Just take note, because it's through paper or by mail, it will take a little longer than usual. Usually if you apply online, like you may get like maybe like 2 weeks processing. So it's preferable always to do online to be more, to get the money faster, but whatever works and whatever is most convenient for you guys, just you guys can do whichever one. So here's some eligibility criteria to determine when you should start applying for an OAS. So just take note, everyone can receive the OAS. It doesn't matter whether you worked before or not. So employment is not really a factor of applying for this kind of pension. So as long as like you were a resident of Canada, I'll go through those later. But you can receive this OAS pension whether you live in Canada or not. So like, let's say maybe sometime down the road, you guys decide to like move to another country, you will still qualify for this OAS. And some of the criteria here is the age. So you get this when you're 65 or older. And you have to have been a Canadian citizen, or you were a resident of in Canada by the time you turn 65, or by the time you submit an application for the OAS. So you should also have resided here in Canada for at least 10 years since you turned 18. So like, let's say there are some immigrants who come here, just as long as you've resided in Canada and you meet the requirements like the age and citizenship or residency, then you can apply for this. And there's just a lot of numbers here, but we won't go through those in detail. I'll just leave them here so you guys have an idea of maybe an estimate how much it would be per month or per year. So the amounts that you usually receive them sometime starting like April or June. So it also depends what your age is. Like if you fall within like 65 to 74 years old, your monthly payment would be close to like 700 per month, or annually it would be around like 8,000. And also if you're like more than 75 or more, it'll be around like 760 per month. There's like a 10% increase from whatever it is you were receiving before. And total per year, it would be around 9,000. So this is also based on your net income for the year. So net income, it would be around, let's say 130,000. So anything higher than that, you may not be able to receive it, or you may receive it, but the government will kind of take it back from you because you're earning. They're basically saying you don't need it because you have enough income to support yourself. And take note that the OAS pension, it's dependent on the cost of living. So if the CPI increases, then it will increase. But take note, if the CPI doesn't increase, like it decreases, like your OAS amount will not be affected. And just take note that this also doesn't affect the amounts you receive for the guaranteed income supplement, which we will go over later, because one of the qualifications to apply for guaranteed income supplement is to be receiving the OAS amount. So it's kind of, if you receive both, that's actually like the best scenario. And another thing here is, let's say you applied for the OAS late, although it's usually automatic application. If you ever have to apply manually and you don't apply on time, you can receive retroactive payments up to 11 months that you missed out on. So it is always recommended that once you turn 65, like just take note to like be aware to apply to make sure you're receiving the OAS. And also this depends, like the amount also depends. So if you've lived in Canada for at least 40 years, then you will get the full OAS pension until you pass away. But if you live like less than 40 years, then the government will sort of like prorate that according to the number of years you live here in Canada, as long as it's more than 10. And you can also choose to delay receiving your OAS. So if you have up to 5 years to decide when you want to receive OAS. So you have up to like any time from 65 to 70 years old. And the longer you delay the OAS, receiving the OAS, the higher amount you will get per month. It's really more of like a question of, do you need the money now when you turn 65, or are you able to like defer it up to like 70? Which we will also discuss later, some decision factors, whether to determine whether you should get it now, or maybe you have the option to defer it. So usually you don't want to delay receiving your OAS if you are over 70, because you may just lose it or like receive less amount than you should. So it's best to apply and make sure you're getting this sometime when you're 65 to 70 years old. And so my head is in the way, but for OAS, there's this thing we call recovery tax. So what this means is, if you are earning more than the threshold, like for your income, government will say you don't need the OAS. Why should we give it to you? Because you're earning enough to support yourself. So they will try to recover some part of it. Either they recover some part of it or they recover all of it. Depends on your income. So really, like if your net income is more than like around 80,000, this is based on the 2021 number, because the OAS is paid like from July to June 2022 to 2023 based on like 2 years net income ago. So it's, if you're earning more than 80,000 in a year, this includes maybe like your investments, maybe unemployment, or your other pensions that you receive. If it goes up to more than 80,000, just be aware that the government will try to recover some part of it. And it really also depends how much they recover based on your income. So usually it would be around 15% of the income thresholds versus what you earn. So for example, let's just say you are in sometime age 65 to 74, you earn more than 80,000, but you are below like 130,000. What they will do is, let's say you earn 90,000. So what they will do, they will recover 15% of 90,000 minus 80,000. That makes sense. And then next. So next one, we will go through the CPP or the Canada Pension Plan. So this is also one type of retirement pension that you can receive, and similar to the OAS, you receive this monthly. So this one, you have the option to receive it earlier. You can receive it when you're 60, or in the normal age for retirement here in Canada is 65. So that's when normally people receive it, but you can receive it when you're 60, or if you want, you can defer it up to 70. So just take note of these special ages, 60, 65, 70. And just also one thing is, if you receive the CPP earlier, like at 60 years old, you do receive less amount of pension, because it depends on the CPP that you contribute or that you pay out from your salaries. If you defer receiving the CPP up to 70, similar to the OAS, you'll be getting a larger amount per month. And similar to the OAS, this is with Service Canada. And unfortunately, this is not an automatic enrollment, unlike the OAS. So you do have to apply manually. I left the link here, so you guys can also check out how to apply manually. So as mentioned earlier, the eligibility starts when you turn 60. And so if you need really, like, for example, you need the cash now when you're 60, then you may need to apply for the CPP, or you may want to apply for the CPP. But if you're okay financially, let's say, you may choose to defer it up to your 70 years old, or maybe when you're 65. So some of the eligibility requirements here as well for the CPP is that you have to have contributed to the CPP at least once. So what that means is you should have either contributed it through work, could be like, it could have been a part-time job back in the day, or maybe you guys are working right now. And also you could have also received it through CPP credit splitting. So what this means is, for example, let's just say it so happened that you get a divorce or a separation from a former partner. Then what would happen is, when you apply for the CPP, you would have to like say how much is the CPP contributions or salary they've had like over the years. Like there should be like some records through CRA, so nothing to worry about that. And they would try, like Service Canada would try to calculate how much CPP would be split between you and your former spouse while you guys were living together. So this is one, let's say you've never had a job before, or you've never contributed to the CPP, let's say, but you have a spouse that did. But if that's the case, that doesn't mean you cannot receive CPP. You still can through the CPP credit splitting, because what the government will do is they will try to split some of your spouse's CPP contributions, and in that way you would have contributed to the CPP somehow, like indirectly. And also take note that you can receive the CPP while you are still working. So like, let's say at 60 years old, that's still a working age, and you want to say, like, you want to be receiving the CPP right now at 60, then you can still, you'd still be contributing to the CPP through work, but also you'll be receiving it as well. And I'm just leaving some numbers here, how it would look like if you receive the CPP before you're 65 and after, and if you choose to defer it up to 66 or up to 70 years old, then there's quite a big difference. So if you choose to receive CPP before you are 65, or like let's say you start at 60, the maximum reduction of the amount is around 36%, like in your entire life, I guess. But like per month, it may not be that big because it's like 0.6%. That's pretty small number. But like if you look at it like as a whole, it can be pretty big, like 36%. So as much as possible, we do recommend that you start getting CPP when you are 65, but the only time that you would want to receive CPP at 60 or before when you're 65 is special circumstances. So also one thing is if you start to receive CPP after 65, let's say you want to defer it up to 70, you have maximum increase of up to 42% if you start at age 70 or after. So it is a big difference. So maybe something to keep in mind. Oh, also, I'm sorry, I cannot say the actual amounts because it really depends. The CPP you receive depends on how much your income is. There's a certain calculation for how much you would get. And so this is basically like what I'm talking about. So the amount you receive for CPP, it depends on your age, when you start getting it, how much have you contributed to CPP over the years, how long have you been contributing, what is your average earnings throughout your working life. And some of the things that can affect the amount as well is, for example, you're receiving the CPP retirement pension, and then you also, you receive the CPP retirement pension. This can also increase the CPP post-retirement pension that you receive. So basically what that means is, let's say you're at 60 years old, you choose to receive the CPP from the government. So the CPP benefit that you get, that would be called the CPP retirement pension. And let's say you choose to retire when you're at 70 years old. So any CPP received at 70 or after, because you're not working anymore. So that means that's a CPP post-retirement pension. And then it also depends when you start contributing to the CPP. So contributions after 65 years old, like for example, you choose to contribute to the CPP after 65 still, because you have up to 7 years old, that would help increase the amount of CPP that you would receive down the road. And also, like if you just so happen like you were not earning any income throughout 8 years, they won't, the government will not include that in the calculation. They usually just take up to like 40 years of your best years of earning income, basically. And there could be also times when you raise children, so there could be maternity or paternity leaves, so that can affect like how much you contribute to the CPP through work. Or if there's a disability period when you had a disability, or if you have share pension with a spouse, and also like as mentioned earlier, if there's a divorce or separation. For the pension sharing, we will talk about that later. So here's just an example of how much CPP you will be receiving. So maximum that you receive monthly is around 1,300. So that's if you start receiving it at 65, which is the ideal age. So in a year, you could get up to a maximum of around 15,600. But just take note, that's the maximum. in my experience at work, I haven't really seen anything that goes up to 15,000. I would say the more normal range is around the average there that I've left here, around 9,000, 9,700. It goes from 9,700. I would say the highest that I've seen through my experience that I can remember is around 13,000 per year. So like we talked about earlier with the OAS and the CPP, you can choose to delay when to receive it. It doesn't necessarily have to be at 65. You can choose up to 70 years old. So here's some decision factors that can help you decide whether you should receive the CPP now or you can choose to defer it. So it really depends on your personal circumstances, mainly like through your health, financial situation, and what are your retirement plans? Basically, when do you want to start retiring? If you have certain like financial goals, I say, it really depends. So choosing to delay the CPP payments or OAS payments is if you're healthy and you have access to other sources of income. So maybe you have a side job, or so you have employment income, maybe you have a side job, maybe you also earn investment income like dividends or interest, or maybe you sell shares or securities and you get capital gains. So it really depends on your financial situation. I think that is like one of the biggest factor here. And you may choose to receive the CPP payments or OAS payments earlier. So one thing is to take note is when do you want to retire? Basically, do you want to retire at 60, or do you want to retire at 65, or do you want to retire at 70? And if you need the money now, so that can help meet, I guess, your monthly needs, or at least help lessen the financial load. So if you're also paying off debt, you may also, and if you don't have other access or sources to cover a debt, maybe you want to use the payments through the CPP. And I left here the link for the application, so you guys can check it out. There's an online application, which is most recommended because you get the CPP approved fast and you get the money fast, like within 7 to 14 days for processing. But you will need a Service Canada account. So you guys can check that out. Or you may also apply manually by paper, mailing it in to Service Canada. So this one takes long, up to 120 days, or that's around four months. So it really depends what you're comfortable with, or if you can afford to wait 4 months, that's fine. So here are also some other kinds of CPP benefits. So there's the post-retirement benefit that we briefly spoke about earlier. There's a disability benefit, like a disability pension. There's a post-retirement disability benefit, which is sort of similar to the CPP post-retirement benefit. You're just receiving it because of disability. And there's also a children's benefit, like for example, if one of your dependents or children also has a disability, the government can give you a little bit more than they would normally for other people. And there's one thing that I also want to bring up that Alan and Susan were talking about before with me, is based on their experience when they received the CPP disability pension, and by the time that they were ready to receive the actual CPP, just the CPP benefits, not the one for the disability kind, they received a lower amount that they normally would have compared to other people. So just something to take note, so that when that does happen, you're not surprised. Unfortunately, the funny thing is, I tried to look into that on the CRA website. It's funny how they don't say it that way. So Just something to keep in mind that based on other people's experience, it actually does happen and it's true. So I guess not everything you should trust on the CRA website. And you can also receive some CPP benefits because of death. Maybe like either a spouse or maybe you have a child who unfortunately passed away. You can receive CPP for benefits because of that, or also because like a death benefit as well. So death benefit is it's like 2,500 a year. Sorry, it's just a one-time thing, 2,500, and you would receive it maybe because either you are a spouse or you are a beneficiary in their will. It's possible to receive this. So just a little bit about the disability pension or CPP. So just take note that you cannot receive the CPP disability pension and the CPP retirement pension at the same time. So this is actually what like we were talking about earlier. You would receive the CPP disability pension, and then when you choose to actually retire, that's when you start receiving the CPP retirement pension. So unfortunately, you cannot receive this at the same time. And after you turn a certain age, like at 65, the CPP disability pension that you receive, it will automatically convert into a CPP retirement pension. So some additional eligibility aside from the usual eligibility for a CPP is you'd have to have a mental or physical disability that stops you from doing any type of work. And this should be like a long-term or indefinite kind of situation. So here's just if for more information, you guys can check out this link. It's basically just gives you more information on what exactly the CPP disability pension is and how to apply for that. And so we're done with the taxable income or benefit part. Now we go to the tax credits. So tax credits, just take note, this is different from expenses that you can claim towards your taxes. So by expenses, it could be like, for example, RRSP contributions. Let's say you contribute 10,000 towards RRSP. That 10,000, you can take that sort of like an expense towards your taxes. So it will decrease your net income and decrease your tax bracket and help you decrease the taxes that you need to pay, or if you need to pay. So tax credits basically just means this is almost available to everyone as long as like you meet these certain conditions. So tax credits means it will help decrease your taxes by around 15%. That's just the federal rate. If you are in Ontario, it will be around 20%. If you're in Saskatchewan, around 25%. If you're in other provinces in Canada, it would be around 20, I guess it would be around 20-25% or 20 to 30%, depending on the provincial rate where you live. If you need more information, I also left the link there. But I believe those joining us here, most of you are from Ontario or Saskatchewan, so I've put that there. And here are some tax credits that we will be talking about. So the disability tax credit, the eligible dependent amount, a caregiver amount, some about medical expenses, home buyers, and home accessibility expenses. So starting off with the DTC or the disability tax credit. So this is very important. You want to make sure if this applies to you that you submit an application to CRA so you are not losing out on getting this tax credit. So you would want to fill out form T2201 or the disability tax credit certificate. And this one, it's a very, very long form. but really like the only pages that would apply to you that you need to fill out would be the first 2 pages or part A. So this is about information about you, like SIN number, address, birth date, all that. And if it so happened that maybe you have a supporting family member who wants to claim the DTC for you, they can be the one to apply for this on your behalf. So basically, a supporting family member they're the ones who provide you all the basic necessities of life, such as the most important food, shelter, and clothing. And they have to be providing this to you regularly and also consistently. So that's the definition of a supporting family member. And just take note, based on experience, CRA is kind of strict on this, the DTC tax credit certificate. They want to make sure that you do have this DTC certificate, your eligibility period. Sometimes it would say maybe from 2023 up to like 2020, maybe up to just 5 years, and then you have to like keep applying, or sometimes in CRA's record, it could be from 2023 to indefinitely. So that's also like something you guys may want to like make sure that your DTC eligibility period still applies, especially for the time when you start preparing your tax returns. Because if, for example, you're not quote unquote not eligible for the DTC, or your DTC expired, and if on your tax return you're claiming that amount, CRA may not accept that, and you may be paying more taxes because of that. The good thing there though is once you resubmit the DTC application, they can adjust your tax return. For example, you applied for 2022 for the DTC, but at that time, let's say your DTC expired already for 2022, but based on your condition, you should still qualify. So you'll let your doctor sign it, and you submit it to CRA. Once CRA processes it, CRA can choose to adjust your tax return for 2022 and include that DTC. So, but to do so, just make sure that in the in the DTC form, you want to make sure you check off that you want CRA to adjust your previous tax return, so that it's not a hassle for you. You do not want to be the one adjusting your own tax return. Just let CRA do it. And also like your authorization or signature. And the rest of the pages, it's a very long form. The rest of the pages would be filled out by your medical practitioner. So they don't need to fill out all the pages, just the ones that apply to you, and just submit the ones. You can choose to submit the entire form to CRA, but just submit basically the most important information there is the first 2 pages that you fill out, and the information that your medical practitioner fills out, and their signature as well. So you can choose to submit this online. If you have a CRA account, if you have access to your CRA account online, you can do this. Or you can choose, if your accountant does, they can do this for you as well. Or you can choose to submit it by mailing it. And I just left the mailing address here. Actually, I'm sorry, because this is just for the Ontario one. You may just have to double check which is the tax center that is closest to you based on your province or your city or which area you live in. So, and of course, the recommended one is always to submit online if possible. So CRA receives it right away. You don't want it getting lost in the mail, or maybe pay for tracking if you're stingy like me. So another one is, so how much is your disability tax credit that you'll be getting each year? So maximum amount from 2022 is around 8,800. So if this 8,800, if you use this entire amount, it can help reduce your taxes by around, let's say, at least 1,300, just considering the federal amount, which is 15%. But depending where you live, it could be up to like 1,700 or 2,200. And just take note, so the DTC tax credit, you as the person who has the disability would want to use this up, especially if you're, for example, you're earning income and the income that you earn is, like, it's high and you don't want to be paying taxes. This DTC should, first and foremost, you should be the one getting this. But if, let's say, you'd be able to afford, or let's say maybe you retire and you're not earning as high of an income as you used to, then you can choose to transfer this disability tax credit to a supporting family member. And if, for example, you can also choose to use maybe just only 4,000 or however much of that 8,800 that's available to you, and whatever it is that you don't need to decrease your taxes or you don't need to use, you can transfer it over to a supporting family member and they can claim the other portion as long as the total does not exceed 8,800. And another tax credit available is for an eligible dependent. So if you have a dependent and the supporting family member provides for whatever their needs are, for example, you are, let's say, I usually see this to people who are separated or divorced. So they can claim this eligible dependent amount because they are supporting or they're providing financial needs for the child. So this one, you can choose to claim this eligible dependent amount as well. So the maximum amount for 2022 is around 12,000 to 12,700 to around 14,300. And this can help reduce your taxes by around, let's say, average like at least 2,000, just considering the federal, and it should be a little bit more if you consider your provincial rates, but just take note of that. And another is the Canada caregiver amount. So this can be claimed by a supporting family member, but the only thing is, to be a caregiver, it's because, for example, let's say husband and wife, let's say, unfortunately, the husband would need some care because of their health situation. They let's say the wife is taking care of them financially, mentally, physically. So what would happen is the wife can claim this Canada caregiver amount, provided that the husband would not, the income that they earn is between a certain range or amount. It would be around 7,500 or 2,500 a year. So if, let's just say, it so happened that the husband earns more than that, let's say they earn 30,000, maybe because through work, so maybe some passive income that they have, then the wife will not be able to claim this caregiver amount. So the maximum amount that you can get for 2022 is 7,500, and it can help reduce your taxes by at least $1,000 to $1,500, depending on which province you live in. And one of the things may be curious about is the medical expenses, because this is one of the most common things that we always see in a tax return that's sort of applicable to everyone. So take note that medical expenses, so just a simple overview. For medical expenses, this can be claimed within any 12-month period ending in 2022, but let's say it's 2023. So any 12-month period ending in 2023. So normally people would think they can only claim medical expenses between January to December 2023, but that's not just take note that that's not usually the case. Sorry, I mean, that's usually the case, but that's the most normal or most common thing that comes to people's mind. But just know that you have the option to claim it like any month, like starting from any month, as long as the ending month is sometime in 2023. So like, let's say it could be from July 2022 to June 2023. Then you can claim that on your 2023 tax return, as long as the amount that you're claiming has not been claimed before in your previous tax returns. And to be able to claim medical expenses, unfortunately, there is a threshold that the government is setting. So it's either, whichever is the lower, either 3% of your net income or either around 2,500. So basically that means if you are, let's say, a high income earner, your minimum threshold would be anything more than 2,500. So if your medical expenses are, let's say, 10,000, you can claim 10,000 minus 2,500 as medical expenses. So around 7,500 that you can claim towards your taxes. But like, let's just say you earn, just for simplicity, let's say it's 10,000 a year of net in that you have as your net income. So that's your minimum threshold would be 3% of that. So around 300. So if you have medical expenses more than 300, then definitely you can claim those as towards your tax return. Usually the 2,500 amount is usually just for people who earn more than that. Sorry, let me just calculate that just to guys give you an idea. So usually if you earn around 82,000 or more, the threshold of 2,479 would be the one to apply to. So if you're earning, let's say 83,000, just to keep it simple, and your medical expenses are less than, or let's say it's just $1,000, unfortunately, you won't be able to claim that towards your taxes because it's less than the threshold. And also take note that the medical expenses that you can claim towards your taxes is only for out-of-pocket costs. So anything that is not reimbursed by your insurance or not reimbursed by your work are the ones that you can claim. So another thing as well is something to take note or to keep in mind is you cannot claim both the medical expense and the DTC tax credit. So unfortunately, CRA does not give us this option, which is such a waste, and I don't understand why, because the people who have the people who need this the most is like they're not giving this, which is doesn't make sense. So how to know whether you should claim the medical expenses or the DTC, well, like which one would be better for you, is based on the amount of the medical expenses that you have. Let's say if your medical expenses is below, let's say below 8,800, it may be better for you to claim the DTC. So 8,800, that amount is, by the way, is the DTC maximum amount for the year. So let's just say it's 8,800 for 2022. So if your medical expenses are lower than 8,800, then it would be better for you to just claim the DTC itself and not claim the expenses, the medical expenses. But if, let's say, you have high medical expenses, it may be better for you to choose to claim the medical expenses itself, and the DTC unfortunately would not apply anymore because your medical expenses are too high and it's more beneficial for you, and you'll be saving more on tax if you choose to claim that. So I'm leaving here a link for the CRA website so you guys can check out what are some common medical expenses. Just take note, this is not a conclusive list from CRA. So if you happen to not see the expense that you're applying that you're curious about, don't worry, you may still be able to claim that as towards your taxes. And this would also tell you what are the eligibility and requirements for you to be able to claim those kinds of expenses. For example, do you need a prescription? Do you need some sort of certification from your doctor? Do you need a DTC tax credit certificate? For example, let's say for a service animal, it's if you just type in the CRA website that service animal, you will see there that it's an eligible expense. You don't need a prescription for it. You don't need certification, and you don't need a DTC certificate either. So you can actually, if you have a service animal who is trained for your health or mental needs, then you can claim whatever expenses that you have for them, like veterinarian expenses or food necessities. Then you can claim those towards your taxes. And other common medical expenses that we have would be attendant care, nursing home, care facilities, training costs for attendants or caregivers, and home accessibility expenses. So take note that these expenses, you can claim them towards your taxes. So attendant care, for example, you're paying a caregiver some like annual salary, let's say, to help support you or maybe a family member, then you can claim their salary as a medical expense and towards your taxes. Another thing is at nursing homes, you can usually you would get, maybe at the end of the year or come tax time, you would get or request a statement from your nursing home, and they would give you a statement that will detail all the breakdown of how much you've paid the nursing home and what goes towards what. So just take note, you won't be able to, for example, if you paid the nursing home, let's say 50,000 a year, just take note, you may not be able to claim that entire 50,000, maybe just a portion of it, because the only amount that you can claim there is anything that relates towards your medical or attendant care. However, if you live in Ontario, we have this thing called Ontario Trillium Benefit. So any rent portion of whatever you pay this nursing home, let's say you pay the nursing home 50,000, 30,000 is towards rent for the year. You can claim that 30,000 towards your Ontario Trillium Benefit and maybe get some benefit from the government. So at least you're not losing out on that entire 50,000 if you're not able to claim them. So another thing is for care facilities. If you are, this is sort of, I guess, like a nursing home. If you pay whatever you need to pay to get the medical treatments that you need, you can claim this towards your medical expenses. Training costs is, for example, you have a, let's say you have an attendant, and let's say they need to go to a school or maybe some training course to help them care for you better or care for a family member better. Then you can claim those training costs that you pay on their behalf towards your tax reliefs. And another thing is home accessibility expenses. So one thing to take note is home accessibility expenses, they're another kind of tax credit itself. But the good thing here is if you pay home accessibility expenses, you can also claim them towards medical expenses tax credit and towards a home accessibility expense tax credit. So you can claim them in both. We'll talk about what home accessibility expenses are more later, but just something to keep in mind, because usually this is not something, one, it's not very common. So it mostly like people don't think that, oh, you can actually claim them on both categories. We'll go over the home accessibility later. So for now, we'll just go to the home buyer's amount. So home buyer's amount, what this means is when you usually when you're like a first-time home buyer, by first-time home buyer, there's certain criteria on how you meet that first-time home buyer criteria. Something like you've never owned a house in your previous 4 years, or most recent 4 years, or you've never lived in a house that you or your spouse or coworker, oh sorry, common law partner owns. So that way you can still qualify for the home buyer's amount. But one thing here is you do not have to meet this first-time home buyer's amount criteria if you are eligible for the DTC. So, and if the home that you purchase is for someone who meets the DTC, who has a DTC. So basically you don't need to meet that 4 years requirement or minimum 4 years requirement. Like, let's say you buy a house today in 2023, and let's say in 2024 you choose to buy another house. Let's say you're supporting someone who also has a DTC, then you can claim this home buyer's amount in both years, in 2023 and in 2024. So the maximum amount that you can claim though is 10,000. So this 10,000, it can be split between you and your spouse. It doesn't matter how much each person gets, as long as both of you combined total is 10,000. So this one can help reduce your taxes by at least 1,500 federal and at least 2,000 for provincial. So it's good to be able to claim this if it applies to you. So just something to keep in mind. So next is home accessibility expenses. So to be able to qualify for home accessibility expenses, you have to be at least 65 years or older. So, and you have to be eligible for the DTC. So what this means basically is, what are the things that you do for your home to help you be more mobile, or to make living at home be more comfortable or more functional. So eligible renovations usually would be like anything that applies to your main or primary residence. It has to be a permanent part of your home. Let's say maybe like a wheelchair ramp, if that's something that is needed. Then whatever you pay a contractor to help you fix the home to make that wheelchair ramp, that you can claim those expenses towards your taxes. So, and also some eligible renovation would be like what I mentioned earlier. It helps improve the accessibility, mobility, and functionality of your home. It reduces any harm to you. Let's say shower. Shower is one of the most dangerous place. Even I get slipped and I get so scared when I hit my head. So like usually, like if you make some improvements to the shower, for example, something maybe like make it not as slippery, or maybe add a handle for the bathtub, like those kinds of expenses, you can claim them towards your taxes. So here, the maximum amount for 2022 is you can claim up to 20,000 worth of expenses towards to help decrease your taxes. So it helps decrease your taxes by at least 3,000 just federally, and it will be higher for provincially. And just as mentioned earlier, just take note that home accessibility expenses, you can claim them both as medical and home accessibility expense. So that's one good thing about it. Yeah, and then so finish with the tax credits that's available. Now we go to other things. I would say like pension splitting. We'll talk about the registered disability savings plan briefly, disability support payments, and the guaranteed income supplement, or GIS. So pension splitting, what pension splitting is, you want to split your pension between you and your spouse or common law partner. So, and it's a joint election each tax year. So that means this, if it applies to you or if it's beneficial for you and your partner to do this, then it's something that you have to keep doing every year, and like sign a tax form, sign the tax form by both of you. So the tax form is called T1032. So your accountant should know this, or if just something to take note, this may be something that if it applies to you, that's the tax form that you need to look up. So basically what this means is you can split your pension to your spouse. For example, husband and wife. Let's say the wife earns a higher income compared to the husband, let's say. So the wife is at a higher tax bracket, and let's say they have some pension that they received. Also, it also depends what kind of pension that you can split, which we will go over later. So like, let's say they have pension that they receive, and it will help reduce their taxes if they can split that pension with their husband. Maybe let's say they have 50,000 of pension that they received in the year. Maybe they can choose to split 25,000 or split half. It doesn't necessarily have to be half, like it's totally up to you, whatever is most beneficial towards your taxes. So they can split, let's say 25,000 goes to the wife, and the other 25,000 will go to the spouse or the husband. So how that will show on the tax return is the 25,000 would be shown as an expense on the wife's tax return, and the 25,000 that gets transferred to the spouse or the husband, that will show as income, additional income on their tax return. So this is normally recommended if both spouses or common law partners' tax situation is different. So if one is in a higher tax bracket or is in a higher tax rate, then this may be something that they may want to consider. But if they have the same tax bracket, or they're essentially like the same tax rate, then, or they're earning almost equal income, then this pension split doesn't make sense. So here's some examples of what kind of pensions would be allowed for the pension splitting. So one thing, unfortunately, the CPP is actually not an eligible pension because I guess it's received from the government. Maybe that's why. So normally, if it's a private pension that you received maybe from your employment back in the day, this is something that you can choose to split. Or if you receive RIF or RRSP retirements, you can choose to pension split this. Another is if you receive foreign pension, maybe you're also a citizen of another country and you qualify for a foreign pension, then you can receive this as well. Just something to take note is for foreign pension, you can only split the amount that is taxable. So sometimes there's some tax treaties with Canada and that other country, and some amount may be exempt from tax or tax-free. Then that portion that is tax-free cannot be used towards the calculation of how much the pension split. I still have a few slides, but I'll try to go over them quickly. So one is the RDSP, or the Registered Disability Savings Plan. So just something to take note that if you do contribute to this RDSP, it's not tax deductible, unlike an RRSP. So RRSP, if you contribute to them, you can claim them as expenses towards your taxes. The RDSP, unfortunately, is not. So there is no tax benefit in that sense. But you get some tax benefits from the government. So this can be made until the end of the year, the beneficiary or you turn 59. And if you do make withdrawals, so one good thing is like because the contributions were not tax deductible in the first place, if you choose to withdraw their contributions, that is actually not tax deductible. Sorry, that is actually not taxable. Unlike for an RRSP, let's say you withdraw an RRSP, you can be taxed on that withdrawal, but for an RDSP, you will not be. The only taxable amount for you would be any income that you earn. So any investment income that you earn. So let's say you put in, let's just say 50,000 towards your RDSP. And then let's say down the road, that increased to 60,000 because the money grew, you've got more investment income out of that. So if you choose to withdraw that 60,000, that 50,000 that you've put in the past, that would not be taxable, but the 10,000 that you earn from investment income or whatever you put it on, that 10,000, you will be taxed on it. So also you'll be receiving some benefits from the government, like grants. So the government can match your contributions depending on by certain amounts, depending on your family net income. So usually these amounts would depend whether you contribute, whether your family net income is below 100,000 annual or higher. And you can also have a bond from the government, so they can fund up to like 1,000 a year, depending on what your net income is. But this is only available if your net income is up to like 50,000. Like that's the maximum. If your net income is more than that, then you won't be receiving this bond from the government. One thing as well is the disability support payments. So what exactly is this? So these are expenses that you pay in the year so that you could go to work, to school, or maybe whatever else. So one thing would be, I would say an example is a braille printer. Like a braille printer, you may need that for work or for school. So this one, you can claim it as a disability support payment. You also have the option to claim it as a medical expense because it qualifies for both. Just also take note that it doesn't mean that all expenses that qualify for disability support payment also qualify for medical. It really depends. You may have to like look that up. But something to take note is if you claim, for example, the braille printer for both as a disability support payment and as a medical expense, unfortunately, that's not allowed. You cannot claim it in both areas. You can only claim it, you have to choose which one. Either you want it as a medical expense or you want it as a disability support payment. I would say if it qualifies for both, let's say that braille printer, it's recommended to claim it as a disability support payment. So if it qualifies as a disability support payment, claim it as a disability support payment first, because the medical expenses, that has a threshold of like 3% of your net income or around 2,500. So like let's just say that is your only expense, a braille printer, let's say, and that costs, let's say, $1,000. If you claim it, you can, because it's $1,000. Unfortunately, it may not qualify for a medical expense, but you can definitely claim it towards a disability support payment. So that's like one of the cases, just as an example. And take note that only you, the person who has the disability, can claim this support payment. Another thing is the guaranteed income supplement. So the guaranteed income supplement, this is like a monthly payment, and similar to your OAS, you kind of receive them together, the OAS and the GIS. And so the qualifications are sort of similar, like you get it like when you're 65 or older. It's calculated based on your income, how much you receive. And this one, the good thing about this is it's not counted as, it's not taxable, unlike an OAS. OAS is taxed, GIS is not. So similar, it has to go through Service Canada, and usually this is automatic enrollment. But if not, you may have to apply manually. And the first payment is after you turn 65, sort of similar to an OAS. And you want to make sure to be able to keep receiving this GIS is to file your tax returns on time and file it on time. So same thing, I just left here some links that may be useful. So how much will you be getting for the GIS? It really depends on your situation, whether if you're single, widowed, or divorced, if you're receiving the OAS, or if not. So an example would be basically maximum monthly payment. Let's say it ranges from around $600 to $1,000. So annually, it's around $7,000 to $12,000. But take note though, you only receive this GIS is if you are earning income that is within this threshold. So anywhere from anywhere less than 20,000, like normally, you can be eligible to receive this GIS. Depends on your situation. If, for example, if you have a spouse who does not receive the OAS, it can go up to like as long as they're around 50,000 net income combined. So how to apply here? It's sort of similar to OAS. So, oh, sorry, I think. Sorry, it's the same slide. Next is just a few things, like just planning for the future is estate planning. So what exactly is estate planning? So this would be like you may want to speak with a lawyer or an accountant to do this, because it will tell you like how your assets or your wealth can be preserved. And let's say after your death, basically it's your legacy that you would be leaving maybe your kids or grandkids. And you may also want to get like a last will and testament drafted with a lawyer. So just get all like the legal stuff done. I remember my friends used to say that like you need a last will of testament. It doesn't matter how old you are, as long as like get it done so it's there. Unfortunately, I have not yet gotten to that. I should. And I just added this small thing. So usually in a last will and testament, people usually include how much they want to donate to certain maybe charities or facilities. So how the donation there, even though it would be after death, you can claim it as a tax credit on the tax return on your final or terminal tax return. So final terminal tax return, that's just what we call your last tax return basically. And it would help reduce your taxes, of course. Another is the graduated rate estate. So this starts from this concept was introduced in 2016 onward, so it applies to anytime after 2016. So it sort of starts automatically when a person passes away, assuming that they do have a lot of assets, and it's worth it to have this graduated rate estate. So basically what this means is your tax rate is based on whatever income you earn. Basically, like while you're still living. For example, you earn 100,000 of income a year, then your tax rate is based on that. Like, I think that's around maybe 35% of taxes. Ontario, federal and Ontario. So if that's how much income you earn, then that's how much you would be taxed on. Or if it's lower, then it'll be lower. So, but take note though, that would be only for the first 3 years. So anytime after 3 years, if you still have this graduated rate estate, any income you earn would be taxed on the highest tax bracket, which is like for Ontario, that's around like 54%. So that's why it was always recommended to have your assets liquidated within the first 3 years, because you don't want to be paying taxes at 54%. Even let's say you only earn net income that you earn, let's say is $1,000. You don't want to be paying almost 50% of that to the government. So yeah. And another concept that I want to introduce is about probate. So probate is when we want to validate your last will and testament through the courts, so that, like, for example, usually the bank needs this, so that the bank knows that they can release their assets or your money to you or to your beneficiary. So it's also called probate taxes or estate administration tax. So this is an asset tax. So what that means is it's taxed based on the fair market value of your assets. It's not on the income that is earned, it's on the fair market value or the value of your asset. So it really depends how much the probate tax is. That's why they say like death and taxes are the most consistent thing, because even after death, you have to pay taxes. So this one would apply if your assets are more than 50,000. So you may have to like pay some probate taxes through the government. So, and the amount also depends on the province. And some assets that where this applies to is usually real estate. That's the thing with the real estate, like the value is pretty high, so the probate taxes can be pretty high as well. So that may be something you may want to consider or keep in mind of. And also investments, so non-registered investments or any other personal properties you have, like vehicles, collections, or furniture, expensive furniture. This can apply. So one way to bypass this probate tax is if you may have to set up like a living trust or like an alter ego trust. We won't go over that too much, but if that is something that may apply or you may be interested in, you may have to speak with a lawyer and an accountant to get that set up for you.
A lot of material there that we needed to take into consideration as we're moving in, getting, well, some of us here are already in that situation, but others who are just moving into it, perhaps. It's a lot of things to consider. And there are some important decisions to make. And I think we've had some financial planning information on this when we had Vince Merton in on a previous seminar. This is a little bit more detailed in terms of what's actually behind what he says too, so it's very important. And I think the disability tax credits when you're adapting your property, I think is an important thing to consider, something that now that we kind of, well, maybe we knew about it before, but it's to bring it to highlight, you don't want to leave that money on the table if you don't have to. So I think that was very good. All right. Okay. Well, Eunice, thank you very, very much. That was really helpful, and we all really appreciate you putting that presentation together and compiling the material. We will have the this available on our YouTube channel. Then we'll have the slideshow available is there as well. So
Oh,
yeah.
sorry, go ahead.
No, I'm just thanking you. Thank you so much. I know this is a lot of work, and thank you for the prep that's involved with this and the time you've taken for it. It makes a difference to people's lives. So thank you.
I'm happy to help.
Thank you, Eunice.
No problem. Thank you, Susan. Thank you,
You did
everyone.
Thank you very much.
lots of information.
Very good. So what we will do now,
Thank
we'll
you.
let Eunice go, and then we'll continue on with a little bit of our roundtable and see how it's going. Again, thank you so much. This is really great.
Yeah.
I really appreciate
Thank you so much,
Great.
Alvin,
your
too,
time
for
with
the
this. So,
opportunity.
okay.
Thank you,
Thank
Eunice.
you.
Yeah.
Thank you so much. Okay.
Okay,
Take care.
bye.